Alright, in this video I want to share another easy method for trading F-dates. And this time what we're going to do is we're not going to use a weekly chart or an hourly chart or a monthly chart to help us determine trend. See, the thing with trading with F-dates is you want to trade with the trend. But the trend for many traders can be somewhat subjective in that they're not quite sure whether the trend should be determined based on an oscillator, should it be based on the weekly price direction, should it be, based on the weather. I mean, it's like you have to decide what time frame you're going to base your decisions on as far as determining what the trend is, and then you want to trade in that direction. We're just going to stick with a daily chart. We're going to stick with a daily time frame, and we're in this particular example here, I have removed everything except for the F dates, and I plotted 3 moving averages. Now I want to show you a very simple technique or method that you can use, and you can trade this method all by itself. You don't have to use any of the other techniques and methods I've taught over the months and years, utilizing the weekly or the monthly or anything else. You can just strictly use this, and you're going to get lots of trading opportunities and lots of opportunities to make profits. I have plotted the actual F dates that has occurred in the Australian dollar of recent weeks here on this chart with these diamonds. I've color coded the top diamonds here blue, and I left the bottom ones alone in red. Now I plotted these up here as a means of reference, okay, so that you can get an idea of which bars qualified as being inside an F date, and the rest of them not qualified because they're outside of an F date, okay? The simple approach is this. I have a 10, a 21, and a 50 exponential moving average. You only really need 2, the 10 and the 21, or 10, 20, or 8, 13. I don't care. It's up to you, but I'm going to show you the ones I'm using is 10, 21, for example, and a 50. I got a 50 on here. But the decision making here is going to be mostly price action in relation to those 2 moving averages and when a price bar forms in an F date. Okay? Now, if the 10 is above the 21 and price is for the most part trading above the 10 and the 21, then we're going to consider the short-term trend to be bullish. Especially important is the angle of the moving averages as well, in that they are slanted either sideways to slanted upwards. That is definitely an important thing to see when you are considering the short-term trend to be bullish. Okay? The opposite for bearish would be if the 10 is below the 21 and price bars are pretty much trading below those moving averages, and the moving averages are sideways to slanted down, is what you'd like to see as additional indication of a short-term bearish trend. As you can see, when we start the chart here, it had just finished coming off of a bearish time period. The 10 is below the 21. The 10 here, by the way, is the blue, and the 21 is the green, and the 50 is the red. So you can see everything is below all 3 moving averages, and we can see that the 10 is below the 21. Now, at some point here, prices started closing above the 2, moving averages, and that's happening right here, as you can see. As we come to this point here, however, the 10 is still below the 21 as far as the moving average, so we don't have the 10 above the 21 yet. When we come to this F date here, okay, we have a possible swing top, which, as we can see in hindsight, actually confirmed as a swing top, and we also have this possible swing bottom. Now, at this time, when this time period occurred and these other price bars are not here on the chart, you have to make a decision if you're looking to possibly trade from this F date. And that is, what is the short-term trend? Well, we can see here, for example, that prices are now trading above. Okay, we call that bullish, right? But the 10 is below the 21. Well, you might be thinking, yeah, Rick, but look at the 10, it's angled up. Clearly, that 10 is going to cross the 21. Yeah, you know what? Don't think that way. Trust me when I tell you that you're going to see that 10 go right into that 21 many times and then bounce right back off of it again, because the trend is continuing in its original direction. All right? So don't ever assume that the 10 is going to cross the 21. Trust me on this. I have worked with this a long time. Okay? You actually want it to be across the 21 if you're going to use these as your further confirmation of a short-term trend. If you don't want to use that and you want to go with just price action, that's fine. That's a whole different lesson in itself, but it's not the lesson of this video. Okay, so you want to make sure that that 10 is above the 21 and prices are either on or above. That's preferable. So in this case here, okay, you might be looking, well, if we look at this as a possible buy, for example, because you're thinking, okay, that 10 is going to cross the 21. Well, by the time that you're filled, because remember, if we're buying, we put a buy stop one tick above the high of the bar that we're buying off of. So by this time here, perhaps the 10 is going to be above the 21. And if you've got this Provisions charting software, you can actually create a price bar for the next day, make it go above the high of your setup or possible setup, and see if the moving average crosses up. If it does, then go ahead then, okay? Because by the time you're filled, that 10 has crossed above the 21, and you kind of get a little jump on it. That's fine. In this case here, we can see that that did not happen. The 10 is creeping up to the 21, but it's not crossing above it when this here made a higher high. Yes, it confirmed a higher swing bottom. Yes, it would have turned out to be a great trade, but you didn't know that. We didn't know that, right? Okay, at the time that this bar formed. And for all you know, it could have been a sell, because notice it did form a swing top first. Now, why would I not have sold below this low here, which would have been horrible, obviously, when this F date occurred? Okay, here's why. And it has nothing to do with the fact that prices were trading, above the two moving averages here, because it's within this group of moving averages. It's still fine. It's when it starts getting out beyond it is when I would worry about it. But it's because the 10 and the 21, the angle of the lines had already started to creep or angle upwards. That to me is a big warning that, I don't think I want to be trying to sell this market. I don't mind the prices, let's say in this downtrend, moving back up and pulling back into the moving averages. Matter of fact, I want that to happen, because that is where I want to sell, for it to go lower and lower and lower. It's these pullbacks that we want to see happening, okay? But the problem here is those moving averages, that 10 and that 21 here, okay, had already started to angle up. You don't want to see that going in the opposite direction of where you want to go in. Either they're They're straight across or angled down if you're looking to sell. You want straight across or angled up if you're looking to buy. Okay? We don't care if price bars are inside the moving averages. That's fine, and you should expect that to happen when prices correct back or snap back to the moving averages. And we're going to see that here in this example. Now, again, I've plotted the actual F dates on this chart, and you can see here that, okay, this did not qualify. So you just don't trade the F date. You ignore it. There's plenty more. Look at all these. There's plenty more. You got to have patience and discipline. Look what happened here. We had another price bar form. It's a lower low than the previous low, okay? But yet it's higher than these previous swing bottoms. That looks pretty good, right? It is also above the 10 and the 21, okay? It's moving in the upward direction. The 10 is now crossing above the 21. It's in an F date. We got it right here. So if we want to trade this now, we can. We put a buy one tick above that high. You can see it was filled the next day. You take the trade. Now you'll notice that as we came up to these two F dates right here, okay, we're clearly not going to buy here because there's no lower low price bar here. So obviously we know there's no buy setup here. There's no sell because we can see that we're trading above the trend lines. The trend lines are all angled up and the 10 is above the 21. So there's no setup here. So the only question you need to ask yourself is, do you want to stay in this trade knowing that you're going to have a swing top occurring here? Now, we have two F dates right next to each other, but only one swing. So obviously, one of them was the swing, and the other one may have been the acceleration, which, you know, to me that's not the biggest acceleration I've ever seen, but you can call it a bust or whatever. You can't use it as a trade, but you can use it as, well, if I do get a swing top, exit. So if you exit, of course, you know, then you're only going to capture, of course, the profits from here to here, which is a good number of ticks or pips, depending on if you're doing Forex or you're doing the straight futures. But then you're going to let the market come back down again. And you'll notice that we come to this F date here. We have this price bar. Here's the first bar that makes a lower low within that F date, right? Well, what's the status of these lines? Well, the 10 is still above the 21. They're both angled upwards, okay? As a matter of fact, the 10 is even above the 50. That's even better, okay? So you can buy one tick above the high here, and let me clear that all off so you can all see this real easy here. So you're going to buy right here. So now we're entered here. We come over here to the next F date, and lo and behold, we have yet another lower low price bar, upward pattern here, price action. See each one of these swing bottoms going higher and higher. Okay, and we have the 10 is above the 21. That's all great. So, and when we enter, we would be entering above these trend line, these moving averages. Perfect. So we would just go ahead and place our order just above the high of the price bar. We're filled here, and so we're into two trades here, by the way, and then the market takes off, and we don't have an F date until we come all the way over here, which is perfect. It hit the exact top, and if you want to get out right when you have the F dates, go ahead and do it, and you capture the profits here. Okay, so far so good. We're making profits. We're not getting lost here, and we're doing better than 1-to-1. Okay, risk ratio. Now we come down here and notice that we have this lower low right here. 10 is above the 21. Okay, so you can go, oh, okay, I have a buy setup. Well, sure enough, you can put it there. You're filled. Unfortunately, this one here would be a loss. Because, you know, I'm assuming that you know, you'll get out right when a swing top occurs here, because that's a counter move against you. If not, if you left your stop below the low here, that's fine too, because it's such a small risk bar, so you have yourself a smaller risk. Then you come down to the next F date, and look what we have. Okay, we have this price bar here. Now it's lower than this little thing here that failed. Okay, but overall in this trend, if you look at things like this is higher than all these here. You put a trend line here. So don't compare it to this little tiny pullback swing bottom, but the trend itself, the whole pattern. I try to get that to be a little clearer. I start drawing all these lines. But if you look at price action, you're doing this. Okay, you're going here, you're going here, you're going up here. Now you come down to here, this little tiny thing, and you go to here. But what do you got here? You've got this underneath these lows here. You could just do this like this. See this? Okay, and you just compare this to back here and back here, and all the way back here. Don't compare this to that little thing right there, since the trend is up. If the trend was down, if the moving averages were down, if these bars were below the moving averages, then your line would be like this, and then of course you'd want to start comparing these tops. But you're not going to be comparing bottoms in a downward move here. You're going to be comparing it in an upward move. I hope that makes sense. Okay, if not, email me clarification. Okay, so in this case here, if you want to get in, normally we'd put the buy above this high here, but the next day made an inside bar. So since it didn't go high enough and it has an inside bar, we now have a new place to put our buy, which it's filled, and it goes up, and then we come to this F date. So we immediately are suspecting a swing top. It doesn't happen here. It doesn't happen here until this bar comes around, so we get stopped off right here, and you make those profits right here. Okay? Again, here we are, another F date. Okay? And we see that we have this potential swing bottom, and again, we're comparing down the line here. All right? All angled up. So what happens is we say, yeah, okay, the 10 is above the 21. Prices are moving above it or pulling back into it, and then we expect it to move back out again, especially if you're going to get filled. You have to get filled right here. Okay? And so if you're going to get filled right there, then prices are going to be back above the trend line naturally, because you're going to get filled right here. You come back up, look, we got another F date again. So there's a possible swing top, and then we see that's happening here. We get out and we collect profits here. So we've collected profits here, we collect profits here. We took a small little loss here, we collected profits here, we collected profits here. All right, can you live with that? These profits, that little loss, these profits, and these profits. Okay, you see how that is? And if you haven't noticed that these F dates here have been remarkable in giving us, the time periods where we want to focus, and that's the ones that are on where these pullbacks are located at. Okay, and you'll notice that the ones that we're using to exit out of were the ones here on the top. All right, some of them right on the money. Okay, and some just off one. So they have been really spectacular in this trendy market. Things get a little messy when you get a choppy market, and that's when it is better not to trade the market rather than expecting the F dates to create a miracle for you. Well, we don't have any more setups here, and then the market here. Now, we'll say right here, this F date here, you could have looked at this price bar right here and said, okay, I have this possible swing bottom. It's an F date. It's above all the moving averages. Great. I think I'm going to go ahead and buy that. Well, yeah, it's a small risk, and you would have lost a little bit, because when it made a swing top the next day here, you would have lost that little itty bitty bit here. Okay, that's up to you if you wanted to do that. For me, this far above moving averages concerns me as far as taking buy setups. I prefer them pulling back into the moving averages and grabbing them there with the F dates, as opposed to these ones that are, floating way up here. Now there was no F date for this one right here, but if there had been, see how it's floating way up here, and it too would not have produced that great. So it's a good thing there was none there. But if you want to take it, go ahead. It follows the rules. It's great. But I like these pullbacks. Okay, let that market come back in. But I wanted you to see how simple that was to utilize one time frame, the daily time frame, slap on a couple of exponential moving averages, and just use that as your guide. But for the most part, it's price action that is going to help you trade with the trend. Okay, and that's what you want to stick with. And these averages just helps give you a guide as to whether there's a possibility that price action is going to be changing direction. All right, thanks for watching, and I'll see you in the next video.